Alrighty, today I want to do something new and share a quick video post with you. So I put out just a brief note in the chat section just about a hedge that I put on today for the Japanese yen position. And I kind of wanted to run through it because there's some subtleties there. And basically I decided to add a new section to the Bleeding Edge Substack called Anatomy of a Trade. And I'll use it for sharing tips, tricks, advanced techniques on how to actually structure risk. So let's just go through a couple of examples, right? So I was moderately bullish the yen. I can't remember what expiry I've got a position in, but I'm in a kind of a clean account here, so I can build everything out clean. So, all right, so the position is basically equivalent to long stock. So I'll just grab a 97 delta call and then shorter call. So what does it look like? So now I think one of the things I wanted to talk about is when sometimes risks are equivalent but not really. So if you put on a covered call, which is a moderately bullish strategy, its payoff diagram, which we're looking at here, is the same as if you sell a put. Okay, so there we have the current price, our short call strike. If it goes down, we still make a profit, down for a small way. But basically, we have limited profit potential and unlimited loss potential. And so if we clear that out and do the same thing, so let's just sell a put and see what that looks like. You'll see it's the same payoff structure, but not the same risk, or at least the way that you can manage it is not the same. So I had on, a 66 call and the long stock position, right? Now, actually, I might just clear this out. I think I was in an earlier expiry, just looking at the premium. I'm just trying to find, here we go. Let's have a look. That looks right. Okay. So I was in April. Now, so what I did is I could see that we were potentially rolling over, or at least, we did get a daily bullish momentum flip, but then that was reversed. So on the daily, momentum is back to negative, and the yen has been in a long-term downtrend. So we've got it back in that negative momentum on the daily, and I saw 30-year yields, or basically US Treasuries and the yen both moving in lockstep again today, and saw that there was a risk of, and sorry about that, it's my little toddler in the background who's going to sleep. So what I did is I put on so if you just have a look here, so this call is taking in $780 in extrinsic value per contract. So that's the time value. And so then if we put on, so let's just clear everything else out for a second. So if we put on this debit spread, which is basically, at one standard deviation down. So we have the long leg at one standard deviation down and the short leg at two. Then that would only cost us, let's look at the curve, $113. So we can put that on for a fraction of the extrinsic value on the call. And so I did that. And then I did it, I can't remember what strikes I used, but I basically put on a second one for a large move. And so then I end up with a position that looks something like this. And so it's just a hedge. I put it on, I think I spent 40%. So, if I was taking in $730 in extrinsic value on the call, I spent 40% of that buying put debit spreads. And they give you, convexity. So you can see here, if the market does start going down quickly, you actually get the theoretical profit, or the mark-to-market profit on those put debit spreads actually accelerates for a bit there, and then it flattens out. Now, if I clear all those out again, so let's go back to our covered call scenario. So other ways you can manage it. So let's say the market goes down and I start making profit on my short call and also profit on the put debit spreads. I can always roll down the call. So let's say, if the current price goes from spot 66 to 65, then I can roll that call down, take in more extrinsic value because this one would have decayed. And so I can add or improve my basis on the trade that way. And also, let's say if we really start to sell off and I go, past the long leg on the put debit spread, I might actually decide to close the long futures position, keep the short call, and now I've got a completely, so I'd end up with a scenario like this. I think I'm limited in terms of how many legs I can put on in this interface. But okay, so let's say I've got one put debit spread and the short call. Now all of a sudden, my payoff diagram starts to look like this. And so I've turned it into a completely negative delta trade. And so you just don't have that flexibility if you sold a put, or you can really do, so let's assume you just sold a straight naked put. All you can do is roll it up. So if the market started to go higher, all you could do is roll that put up and take in some more extrinsic value. Or if the market starts going against you, then the value of that short put is going to start exploding in your face. And all you can really do is add duration to the trade, so roll it out to a later expiry. And then often you can do so and take in a credit. Anyway, hopefully that's helpful. I'll post some more videos like this, just explaining some of the structures that I like to put on and how I like to manage the trades. Hopefully you find it helpful. And if you have any questions, just let me know.